Alright, let's get serious for a moment. We need to talk about your money. Yes, your money. You work hard for it, don't you? You spend hours, days, weeks, and years earning it. So what are you doing to make that money work for you? Today, we will be learning about mutual funds. It might sound complicated, but I am here to break it down for you. Mutual funds can be a fantastic starting point for new investors. We are going to walk through this together, step by step. I want you to understand what mutual funds are. I want you to feel empowered to make smart decisions with your hard-earned cash. Let's dive into the world of mutual funds and see how they can become a powerful tool in your financial toolkit. Okay, so what in the world is a mutual fund? Let's not make this complicated. Imagine you're going to a big potluck dinner. Everyone brings a dish to share, right? One person brings a salad, another brings chicken, someone else brings dessert. By pooling all those different dishes together, you get a fantastic, diverse meal that no single person could have easily prepared on their own. A mutual fund is kind of like that, but with money and investments. It's a big pool of money collected from many different investors, just like you. This collected pool of money is then managed by a professional money manager. Think of this manager as the chef of our potluck. Their job is to take all that pooled money and invest it in a variety of things. These things could be stocks, which are like tiny ownership pieces of companies. They could be bonds, which is money you loan to the government or companies, or they could be a mix of different types of investments. The key idea is pooling. Now that you know a mutual fund is like a big money potluck, let's talk a little more about how it actually works day to day. When you decide to put your money into a specific mutual fund, you are essentially buying shares of that fund. The price of these shares is called the net asset value, or NAV. Think of the NAV as the price per slice of our potluck pie. It's calculated at the end of each trading day. The fund company adds up the value of all its investments, stocks, bonds, etc., subtracts any expenses, and then divides that by the total number of shares the fund has issued to investors. So, if you invest $1,000 and the fund's NAV is $20 per share, you would buy 50 shares of that fund. As the value of the investments held by the fund goes up, the NAV per share also tends to go up. If the value of the investments goes down, well, the NAV will likely go down too. Just like there are many different dishes at our potluck, there are many different types of mutual funds. This is a good thing. It means you can choose funds that match your personal financial goals, your comfort level with risk, and how long you plan to invest. Let's start with one of the most common types, stock funds, also known as equity funds. These funds primarily invest in, you guessed it, stocks. Stocks represent ownership in companies like Apple or Amazon, or maybe smaller companies you haven't even heard of yet. Stock funds themselves come in various flavors. Some stock funds focus on growth stocks, companies that are expected to grow faster than average. These can be exciting but also a bit more volatile, meaning their prices can go up and down more dramatically. Other stock funds focus on value stocks, companies that the fund manager believes are currently undervalued by the market. Some funds invest in large established companies, large cap stocks, while others focus on medium-sized, mid-cap, or smaller small-cap companies. There are even funds that focus on companies in specific industries, like technology or healthcare, or in specific countries. Section 5. More choices for your goals-balanced funds. Beyond basic stock and bond funds, there are other popular types of mutual funds designed to meet different investor needs. One such type is a balanced fund. As the name suggests, balanced funds aim to provide a mix or a balance of both stocks and bonds, and sometimes even other assets like cash. The idea is to offer both growth potential from the stocks and income or stability from the bonds all in one single fund. This can be a good option for investors who want a diversified portfolio but prefer the simplicity of a single investment. The specific mix in a balanced fund can vary. Some might have a classic 60% stocks and 40% bonds allocation. Others might be more conservative with more bonds or more aggressive with more stocks. The fund manager makes decisions about this allocation based on the fund's objectives. These funds are often seen as a moderate risk, moderate reward option. They might not shoot the lights out like an aggressive stock fund during a bull market, but they also might not fall as sharply during a downturn. Section 6. Active hands versus following the market active funds and index funds revisited. We've touched on fund managers making decisions. This brings us to a really important distinction in the mutual fund world: active management versus passive management, which is most commonly seen in index funds. An actively managed fund has a fund manager or a team of managers actively trying to beat the market. They are doing research, picking specific stocks or bonds, and making buying and selling decisions with the goal of outperforming a particular benchmark, like the S&P 500 index. You are paying for their expertise and their effort to achieve these superior returns. The idea behind active management is that a skilled professional can identify opportunities or avoid pitfalls better than the average investor, or even better than the market as a whole. Sometimes they succeed, and when they do, it can be great for investors in their fund. However, consistently beating the market is very, very difficult, even for professionals. This is a critical point to understand. You are paying for the attempt, not a guarantee of success. Section 7. The cost of doing business: understanding expense ratios in mutual funds. Alright, nothing in life is truly free, and that includes mutual funds. When you invest in a mutual fund, there are costs involved. The most common and important one to understand is the expense ratio. The expense ratio is an annual fee, expressed as a percentage of your investment in the fund. It covers the fund's operating expenses, such as the fund manager's salary, administrative costs, record-keeping, marketing, and other day-to-day operational needs. This fee is taken out of the fund's assets, so it directly reduces your returns. Think of the expense ratio like a tiny ongoing service charge for having your money managed and invested within that fund. For example, if a fund has an expense ratio of 1%, it means that for every $1,000 you have invested in that fund, $10 will go towards paying those expenses each year. Section 8. Why bother? The real benefits of investing in mutual funds. So, we've talked a lot about what mutual funds are and how they work. Now, let's get to the good stuff. Why should you even consider investing in them? What are the real tangible benefits for someone like you? One of the biggest advantages, as we touched on earlier, is diversification. By investing in a mutual fund, you are instantly spreading your money across many different investments, potentially hundreds or even thousands of stocks or bonds. This is so important. Diversification helps to reduce your risk. If you put all your money into the stock of just one company, and that company does poorly, you could lose a lot. But if your money is spread across many companies in different industries, and one or two of them don't do so well, the impact on your overall investment is cushioned by the others that might be doing great. Section 9. Hold on now. Smart things to watch for and your key takeaways. Now, while mutual funds offer many great benefits, it's not all sunshine and roses. You need to be smart and aware of potential pitfalls. One thing to watch out for, as we've hammered home, is fees. High expense ratios can seriously erode your returns over time. But expense ratios aren't the only fees. Some funds have loads, which are sales charges you pay either when you buy shares, front-end load, or when you sell them, back-end load. There are plenty of excellent no-load funds out there, so you should generally try to avoid funds with loads unless there's a very compelling reason. Always read the fine print. Another thing to remember is that past performance is not a guarantee of future results. Just because a fund did incredibly well last year, or even over the last 5 years, doesn't mean it will continue to do so. Market conditions change, fund managers can change, and luck plays a role. Don't just chase the hottest fund. Instead, focus on funds that have a consistent long-term track record and an investment strategy that aligns with your own goals and risk tolerance. And remember, all investments carry some level of risk, including the risk of losing money. Mutual funds are not immune to market downturns. If you liked this video, please share and subscribe for more Plain Talk Finance.